Welcome to the program, ladies and gentlemen. Dollars and Cents here on News Radio WFLA Orlando. My name is Joel Garris here on News Radio WFLA. I'm with Nelson Financial Planning during the week, but here on the weekends, we're on the air cutting our radio program, just as we have had to do for the past couple of, well, actually more than that. We've had to tape the program on a weekday morning, so we're doing this program on Thursday morning, and it will air on Sunday, and then of course it will be up on all of our various YouTube sites and the like starting next week, and then you'll be able to see that on a regular basis. So we are doing on Thursday, given all of what's going on. It certainly has been a period of time where there's been a lot of volatility. The only comment that we would make is, given that we're recording this on Thursday, Friday, actually tomorrow, or a couple of days ago, depending upon when you're listening to the program, is actually Good Friday. So the markets are actually closed on that day. So at least there's 1 day of rest for the markets and for folks' portfolio. And then of course, this program airing on Sunday means it's Easter, so we wanted to take a moment and wish everybody a happy Easter as well. Our topics today are a discussion of just how big the CARES Act is. We hear these numbers that are being tossed around. I don't think we quite have an appreciation of just how big a $2.3 trillion stimulus package really is. And then certainly the COVID crisis and these quarantines and the resulting economic impact have really underscored one of the dangers of living paycheck to paycheck. So we wanted to talk a little bit about that on the program today. So welcome again to Dollars and Cents. We're one of the top 25 financial planning podcasts on the internet, and we're excited for that accolade that we received at the beginning of the year, courtesy of the folks at FeedSpot. So the CARES Act, which, again, love Washington and how they managed to put titles of legislation and acronyms together. They're really, really good at that. So the CARES Act, just so you are aware, stands for Coronavirus Aid, Relief, and Economic Security, CARES. Okay, hopefully they didn't spend too much taxpayer money coming up with that, but that's the name of it. And I think when we hear these numbers, I don't think we really have an understanding of just how big $2.3 trillion really is. 2.3 trillion is over 10% of the annual economic output of this country. Over 10%. That's how big it is. A $2.3 trillion stimulus bill from the government represents a 50% increase in government spending over the year 2019. 10% of the economy, 50% increase in government spending. The $349 billion that is available for small businesses. Again, and understand the distinction between small businesses and sort of large corporations that they're drawing here. And they look at your number of employees. So, plus or minus 500. So if you're under 500, you're a small business. Over 500, you are a big business or a large corporation. So the $349 billion that they have earmarked for that, it's rapidly already been applied for. So one of the things that you had to do if you were a small business is you had to work with your existing banking relationship. That was a requirement of the application process. And it certainly was a process that had a lot of evolution. Understand that when you put together legislation that's spending $2.3 trillion, there's a lot of holes in exactly how it's all supposed to happen. And that's what they're continuing to work out. We talked a little bit on the program last week about the stimulus checks and how that's sort of a moving target in terms of how that's actually going to get paid out. The reality is that it's a bit of a moving target in terms of these small business loans as well. It appears that the $349 billion has already sort of been applied for. So this conversation about going back and trying to add another $200 billion on top of that number. The 454 billion, so in addition to the 349 billion, the 454 billion that was reserved for big businesses actually allows the Federal Reserve to leverage that piece, okay? So what that means is that the Federal Reserve can actually leverage that by a factor of 10. In other words, generate 4.5 trillion of loans to big businesses. I mean, these are big numbers that I don't think we necessarily, as normal folks, are able to wrap our minds around just how big these numbers are. It seems to me a little bit, though, that the market is wrapping its head around it a little bit. If you look at how much the market has sort of given a positive reaction or a thumbs up, if you will, to this stimulus package, it really is pretty amazing the reaction and what we've seen in the stock market. And you may not be aware of this because, of course, unfortunately the media likes to focus on the negative side of things. The reality is that you've got a market that at its low point back on March the 23rd, I think it was down 34% from its peak. So peak to trough down 34%. Interestingly, after yesterday, as we sit here again, Thursday morning, it's down about 15%. So kind of interesting to see what the reaction has been for the markets. Down 34 to now only being down 15. I think the market is looking at these stimulus packages and saying, okay, this is a big deal that should go a long ways towards helping the overall economy. Now, what's the average investor done? The average investor probably isn't aware of the fact that, yeah, the market was down a lot, down 34%. Now it's down only about 15% since the beginning of the year. So pretty interesting reaction in terms of the market. And again, I think it's correlated to the stimulus package and also correlated to what the Federal Reserve is doing. Let me be very clear though, okay? I'm not sitting here saying that the worst of this from a market performance is behind us, because I do think there's a lot more tough economic data that are going to be coming out in the midst of this crisis. Much higher unemployment numbers, corporate earnings season, I think, will look absolutely in disarray. And so certainly not saying that the worst of this is behind us from a market perspective, but it might be, especially when you consider that at one point the market was down 34% since the beginning of the year, and now it's only down about 15%. So some interesting numbers on that in terms of kind of what the market's reaction has been. Now, what's the average investor done? Well, I think you probably know what the average investor probably has done, and we're going to share that with you and what's the downside on that. So we'll take a break. During the break, we will listen to some commercials and return and be back here on Dollars and Cents with your host, Joel Garris of Nelson Financial Planning, News Radio, WFLA, Orlando. Welcome back, ladies and gentlemen. Dollars and Cents. This is Joel Garris of Nelson Financial Planning on News Radio WFLA Orlando. And before in the last segment, we were putting some perspective on just how big the numbers are for the CARES Act. $2.3 trillion. That, folks, is a lot of money. And we think one of the biggest reasons why the market has been moving upward as much as it has. You say, Mike, what is he talking about? The market's been moving upward. Well, here's the numbers, because remember, the media only likes to exacerbate when the market goes down. They don't really talk about it that much when the market goes up. So at the worst point, not more than probably about 3 weeks or so ago, the market was down 34% since the beginning of the year. This morning, again, taping the show on Thursday morning, the market is down just 15%. That's a big difference. And one of the things is the size of the CARES Act that really has helped the market kind of begin that recovery process. Not sure it's all behind us, because I think you've got some tough unemployment numbers and some tough earnings numbers for corporations to come out, but certainly interesting to see whether that low point that we're basically 20% above at this point will in fact hold. It'll be interesting to see that. But here's the point. The volatility in the market obviously cuts both ways, both down and up. And if you got out at the worst possible point here, you basically miss about a 20% improvement in your overall portfolio. That's pretty sizable. And unfortunately, we fear, as is typically the case, that that's exactly what most investors did. The flight to cash has been absolutely incredible during this period of time. The amount of physical cash in hand, jumped by nearly 2% for the week ended March 25th. That is the biggest weekly increase since December of 1999. December of 1999. That's back when we were all concerned about Y2K. Remember that? I mean, it's amazing how, how the concerns of 20 years ago look kind of silly, but at the time, I remember it well, we were quite concerned about the complete collapse of anything computer related. I mean, there was even some speculation that you would have planes falling out of the sky because of just how much of a problem Y2K was going to be. So everybody hit up the ATM, and there was a massive jump in physical cash in circulation. We saw that exact same thing play out just recently for the week ended March 25th. Meanwhile, demand account balances, checking and saving, increased by 16%, which was the most in 9 years and the biggest weekly increase since the U.S. credit was downgraded from AAA. Remember that? Back in the summer of 2011. At that point in time, there was similarly a really big increase in the amount of money that was in cash and demand accounts. And the backdrop of all of that is incredibly low interest rates. So go back to the comparison of the CARES Act that we were talking about earlier in the program. $2.3 trillion. It's funded entirely by issuing new 30-year bonds. Those bonds, as of March 31, issued at an interest rate of 1.35%. If the U.S. Treasury is issuing 30-year Treasury bonds at 1.35%, that's why you're getting nothing to hold on to cash. Because if the U.S. government can go to the marketplace and say, hey, we want to borrow money for the next 30 years, and you know what? We'll pay you the handsome sum of 1.35% per year for the next 30 years. That's pretty cheap money. And so consequently, sitting in cash means that you're making like even less, if it was possible, even less than what you were making previously. This to put it into perspective, okay? And that's the low interest rates is one of the reasons why the folks in Washington went as big as they did on this. So to put it into perspective, an annual debt service on $2.3 trillion amounts to $31 billion a year. Again, that's a huge number. We're not saying, okay, that it's not a burden. It is. 31 billion a year is, but just understand the perspective. At 1.35%, your annual debt service on 2.3 trillion amounts to $31 billion a year. During the year 2019, U.S. government had outlays, meaning they spent over 12 billion per day. So basically, the interest cost, the carry cost on the 2.3 trillion is the equivalent to what the U.S. spends in 2.5 days. Stop and think about that for just a second. It is a huge number. It's a big amount of money. No question at all. Do I worry about it for future generations? Absolutely. Absolutely. At some point, we've got to reckon the ridiculous amount of money that this country owes. But in terms of where interest rates are, in terms of the fact that the U.S. Treasury can finance a $2.3 trillion stimulus package by issuing out 30-year treasuries at 1.35%, that's amazing. The only reason why this is this crisis, or in the market response of late, has been what it is because that's an incredibly low carry cost. Your carry cost on $2.3 trillion is $31 billion a year. That's the equivalent of what the U.S. spends in 2.5 days. So that's why they've gone as big as they are. It's kind of incredible when you stop and think about it. And these low interest rates and so much cash, I mean, people forget the history and how quickly the recovery can be. I mean, this most recent market decline marks the 12th bear market since the end of World War II. The average return for the S&P 500 in the first year following the low point of the bear market is 39%. Folks, when you ask the question, I lost money, I don't think I'm ever going to recover it, check your history books. Check your history books. The market recovers very, very quickly. And we forget about that because no one really ever talks about it. That's why we're talking about it on the program this morning. From the bear market low, in the 12 bear markets since World War II, from the bear market low, the return over the next year on average up 39%. Folks, I don't know about you, but up 39% repairs a lot of the damage from whatever a bear market did in an investment portfolio. Again, right now, market was down 34% as of March the 23rd. It's now down only 15% since year to date. That's how quickly it can shift. So when we're talking about the numbers and what's the impact and how soon am I going to recover, which is the question that everybody's asking, just take a look at a little bit of history. That might very well help to provide some perspective and keep some things in mind and allow you to wind up being much more consistent on your investment strategy. The answer to the question is of how soon will I recover? Of course, nobody knows the future, but the reality is you just look at history and you can get a pretty good feel that, hey, you know what? The market moves quickly, both up and down. And so those are the important things to remember. And certainly in terms of those statistics, some pretty amazing statistics, particularly when you think of it relative to how much the stimulus package was under the CARES Act and what the current interest rate environment is. It is shocking, though, the fact that everybody rushes to cash during a period of time like this, and ultimately you're making absolutely nothing. And if you thought you were making a low amount of interest rate on your cash accounts, it's much lower now than it was just a few months ago. So anyway, next up, we're going to talk about one of the most sobering statistics throughout this whole COVID experience that we're in the middle of. One of the most sobering statistics. So we'll tackle that when we get back here on Dollars and Cents. This is Joel Garris of Nelson Financial Planning, News Radio, WFLA, Orlando. Welcome back, ladies and gentlemen, Dollars and Cents. This is Joel Garris of Nelson Financial Planning. We are one of the top 25 financial planning podcasts on the World Wide Web, thanks to the folks at FeedSpot. You're listening to News Radio WFLA. If you're listening to the program on the radio, it is Sunday morning, Easter Sunday, so happy Easter to everybody out there. If you are trying to keep track of when exactly it is that we are doing the program, we are doing it on Thursday morning. Again, COVID rules and restrictions prohibit us from going into the studio. So if you look at the YouTube video, you'll see me in my office, sort of the back side of my office, or should I say, where folks normally sit when they come in to visit with me. If I were to shoot it the other way, there's way too much paper and stuff like that stacked up. So we're trying to make the YouTube video look as clean as possible. So we're shooting it this way, as we have the prior few Sundays. So before the break, we were starting to talk about one of the most sobering statistics that has come out about this whole COVID experience, and obviously this is really creating a tremendous amount of financial strain on many people. I mean, you look no further than these unemployment numbers that are absolutely just jumping off the page. And certainly the financial impact can't be understated. According to a recent survey, here's a sobering statistic. According to a recent survey, 59% of Americans live paycheck to paycheck. What's even more sobering about that statistic is that survey was actually conducted in February, before all of this COVID crisis hit. So that's an unbelievable statistic when you stop and think about it. And I guess the only thing to do at this point is to try and learn from it, and to make sure that the lessons that we experience during this tough economic time are lessons that we all take to heart. And I think that's very true for when we go through tough economic times, that folks do learn things and take them to heart. I think of the financial crisis of 2008, and I think of the time before that when pretty much everybody was just borrowing money like there was no tomorrow off of their real estate. And one of the things that I've observed over the 12 years post 2008 is that people have a very different attitude about borrowing money. Not everybody, of course, but just generally, you can definitely tell that there is a different attitude towards debt, and there's a different attitude towards borrowing money. Most people come into my office and are focused on trying to pay off their debt. And I can tell you, in the 2000s, that was not the case. It was how to borrow more money. So that economic period of time certainly taught a lot of people the importance of maintaining as low a debt as possible and really focusing on that. And my hope is that this economic time will teach a lot of folks the importance of having that emergency savings fund. Look, this is not a new concept that we're rolling out. I mean, we've been talking about this for the past 20 years, and certainly when my father-in-law, Jack Nelson, was doing this program starting back in the late 80s. I mean, that was certainly something that was a main topic, and the importance of having an emergency savings account really can't be understated, and this is a perfect example of that. We all talk about the need to have an emergency savings account and reducing the debt, but for so many of our friends and neighbors, it just got real. And as with any of these lessons in life, you know, we urge you to learn from it. I mean, the thing about this quarantine, and I don't know if you've observed it or not, I certainly have on a personal basis, is it really has stripped things down to that fundamental needs versus wants, right? I mean, we're really focused on now on really kind of what we need to function rather than kind of all of that other stuff about wants. What do I really need at home in terms of groceries and in terms of supplies, versus, I want to go out to eat, or I want to go to a restaurant, or I want to go on a trip. And the reality is that we all have less opportunities to spend. So we want to take this as an opportunity, and less opportunity to spend and more time on our hands. And so we would encourage you to take some time and really look at your past spending habits and how they've changed during this period of time, when a lot of those things that we want to do have effectively gotten eliminated because you're forced to stay at home. So I think the important part of it is that, not that you shouldn't want to do your wants, obviously, but I think far too often in today's world, particularly when so many folks are living paycheck to paycheck, that we forget that distinction between needs versus wants. And we would encourage you, to think about that, particularly now when, you don't really have the opportunity to go out there and do as much of the things that you would want to do, as opposed to the things that you now need to do, and to really try and, I guess, maintain that focus, particularly once this time passes and things get back to normal. I think keeping that focus will help you be better prepared, and hopefully shift more of society. The goal would certainly be that more of society gets out of more of that paycheck to paycheck mindset, and ultimately works to help have that emergency savings account. If you spend less on your wants along the way, that means that you will be better prepared during tougher economic times like this, and even more importantly, you will have more money to do your wants in retirement when you can actually enjoy them. So just think about that, the distinction between needs versus wants, and how that really, perhaps with this economic situation, really has become clarified for so many people. So that's a little bit of homework you can do as you're staying at home, and still a few more days to go under these stay-at-home orders. Be spending some time on that. Another thing you can do is also your civic duty, which is, of course, don't forget to do your census. I think that's all gotten kind of lost in all of this, but the census is certainly ongoing, and we would encourage you to take a moment and complete it. It's actually a pretty quick exercise. I did it. You should have received in the mail a letter from the census with an access code. Use that access code, which is unique to your particular address and the information you got from the census. Use that access code to go online and complete your census. The reality is they're looking for names, ages, and the only real question that they asked, or at least on my version that I completed, was whether you had a mortgage or not on the property that you were living in. So it was really quick. It only took about 10 minutes at most, but certainly something that is worth doing, because once all of this passes, the census is what determines where a lot of federal money goes. So you certainly want your community to be counted. So we would encourage you to also, another little piece of homework, but this one's only 10 minutes and won't take very long at all. Another piece of homework to do during this period of time. So rifle through your mail, see if you can find that access code, and get online and complete the census. We're going to slide to a break. When we get back from the break, we're going to talk a little bit about the IRS, okay, because the traditional tax filing deadline, April 15th, is coming up this week. And even though it's all pushed to July 15th, there's certainly a lot of activity that is happening at the IRS. So we wanted to kind of spend some time and talk a little bit about that, because of course the traditional April 15 date is ahead this week. And so it's always a good time to chat about taxes when we see that deadline approach. So we'll do that when we get back here on Dollars and Cents. This is Joel Garris of Nelson Financial Planning, News Radio, WFLA, Orlando. Welcome back to the program, ladies and gentlemen. Dollars and Cents here on News Radio WFLA Orlando. This is Joel Garris of Nelson Financial Planning. And on this segment of the program, we thought we would talk a little bit about IRS. The tax filing deadline has kind of gotten lost in the shuffle of all of this stuff because the folks in Washington kicked that date out until July 15, and so that gives folks a little bit more time. We continue to encourage people to try and file your taxes as soon as possible for a variety of reasons. First of all, if you're getting a refund, you might as well get that money, number one. And number two, if you owe, you probably want to kind of know that so you can kind of plan ahead and see where that see what that looks like. And then number three, which is not something that a lot of people kind of would put into the mindset, but it is in fact an issue out there. During tough economic times, you see the amount of scams and things like that increase. And so certainly fraud and scams involving tax returns and the like are very prevalent, and particularly prevalent during this time of year anyway, but with the COVID crisis, there's an even greater propensity for that. So if you get your taxes filed, then you eliminate the risk of somebody else trying to file a fake tax return. So some good reasons to try and hold to that April 15th date as best you can. The reality, of course, with the postponement to July 15th, it has postponed pretty much everything, and including your ability to fund an IRA and things like that. So the IRS obviously is dealing with the same thing that every business is dealing with these days, and so as of March the 20th, there were still about 70 million returns left to process. So that's still a lot, as you might well imagine. The sort of tail, the 3 or 4 weeks leading up to April 15th, a tremendous amount of tax returns get filed. So as of March 20th, they still had 70 million to go, with 20,000 less employees than they had 10 years ago. Now, granted, some of that is due to automation, computers, and things like that, but certainly they've got less people to deal with it. They're also in charge of distributing the stimulus checks ASAP, so they're trying to deal with that, and then just like any other business, they've got 70,000 employees. They're trying to build remote capability for their employees. So certainly a lot going on with the Internal Revenue Service, but they are still functioning. They are still operational. They've issued some recent guidelines called their People First Initiative that tries and addresses how the IRS is functioning in today's world. So we wanted to kind of share with you some of the thoughts and some of the features of the IRS's People First Initiative, so that you can get some perspective on those numbers. So the reality is that if you think you're going to try and call the IRS and talk to them, I would probably urge you to think again on that. Their call center is overwhelmed, and they're not able to answer questions as easily as they did. So trying to get a call or live assistance is very limited. The recommendation from them is to go to their website. That website, irs.gov, by the way, that becomes a good resource if you have questions about your taxes. Besides just the extension of the tax filing deadline, any collection activity, whether it's audits or collections for back taxes or anything compliance related, has also been suspended to July 15th. So if you're in the middle of a battle with the IRS about some tax bill, know that also has been suspended until July 15th, along with if you are currently on a monthly installment agreement, meaning that you're paying the IRS monthly on a past tax bill, that also has been suspended. You're not required to make a payment. Now, a little bit of logistics problem in there in terms of being able to stop that payment going. We've heard that some banks won't allow you to stop that and have referred folks to contact the IRS. The problem then goes back to the first problem we were talking about, is that the call volume and the like at the IRS is very high, and the ability to talk to somebody is very limited. But you do have the ability, if you would like, to suspend an existing monthly installment agreement with the IRS until July 15th. So it might be something certainly looking into. Still processing the tax returns, and as we said, it's best to file those as soon as possible. We would also encourage you to include your bank account information on that. That is the way that they're going to be able to get you the stimulus check as fast as possible. So if you're one of those traditionalists who like to mail stuff in, may want to think about bucking that tradition this year and including your bank account information on your return, so that you wind up getting the check, the stimulus checks, as fast as possible. Certainly important to be able to file that. Now, and another thing on the stimulus check, they're looking at 18 if you haven't filed 19. If you file 19, then they're going to look at 19. So make sure that if you're on the line of where the stimulus check is available to you, and remember, it's $75,000 or below if you're single, $150,000 or below if you're a married couple. All of those have phase out, so it's not a hard line. So for a single person, you still would get a stimulus check, but it would be reduced up to the point where your income was above 100 grand. Above 100 grand, you're not going to get anything. Same analysis on a married couple. Stimulus check starts to get reduced once you go above 150 grand. Above 200, you're not going to get anything. So remember those numbers and look at the tax return, because the reality is this stimulus check is a check for 2020, and it is not a check where they would keep it and apply it to back taxes. The only exception on that would be is if there was unpaid child support. So again, important to not just look at the timing of trying to get the tax return done, but also kind of look at the income on those two returns to make sure you're getting the maximum amount of stimulus check. One other comment is that you can still file your taxes and set the automatic debit of any amount that you owe on July 15th. So it's not a situation where, once I file my taxes, they're going to immediately take the money. No. You can set the date to be that future date of July 15th. So the money doesn't come out now, but you can still get your taxes filed and get those all in good order. So certainly important to go through that process of trying to get your taxes done. Even though the deadline has slipped some, it's important to be able to know what that picture is, to know what that picture looks like. And in particular, it might very well speed up the receipt of your stimulus check. So be aware that all of that is still functioning. But the IRS, of course, is not necessarily available on the phone these days because they're a little busy, but they're trying to get out the stimulus checks as fast as possible. One other important thing to note, we've talked about on the program, but we want to also reiterate it again. If you're getting a required minimum distribution, okay, understand that your requirement to take that minimum distribution is suspended for the year 2020. So you do not have to take that. You can let that slide. There's no requirement to make that up later on or anything like that. Now, if you've already taken some or all or part of your required minimum distribution, you can reverse only what you've taken over the course of the past 60 days, and you can reverse that only by putting that money back in the account. If it was beyond 60 days, they didn't really provide for a mechanism to be able to do that. So just know the parameters on the suspension of the required minimum distribution rules. It does not apply, by the way, to an inherited retirement account. Those still have the required distribution rules. So some interesting topics there in terms of the distinction that they draw between those required distributions, but that's what they did. So anyway, we will wrap it on up and get on out of here. Thank you for listening. Have a blessed Easter, This has been Dollars and Cents with your host, Joel Garris of Nelson Financial Planning on News Radio, WFLA, Orlando.